All right, so exercise 5.2 on page 541 says, this information relates to Rice Company, and they have 1, 2, 3, 4, 5 different transactions. And the instructions say, A, prepare the journal entries to record the transactions listed above on Rice Company's books. Rice Company uses a perpetual inventory system. And B, assume that Rice Company paid the balance due to Jack's Company on May 4th instead of April 15th. Prepare the journal entry to record this payment. Okay, so we're going to do A first. Prepare the journal entries to record the transactions listed above on Rice Company's books. Rice Company uses a perpetual inventory system. Everything for chapter 5 is going to be perpetual, okay? All right, so first of all, who are we? Well, we are Rice Company, and Rice Company is the buyer. And how do we know it's the buyer? Well, if we read number 1, it says on April 5th, purchased merchandise. So purchased, you're the buyer. So on April 5th, purchased merchandise on account from Jack's Company for $28,000. Terms 2/10, N30, or 2% 10, net 30 is the way that you read that. So on April 5th, we purchased merchandise on account. So what do we get? Well, we got merchandise, and merchandise is inventory. Inventory is an asset. Assets have a debit balance, so we are going to debit inventory to show the purchase of the inventory. So this is April 5th, and we're going to debit inventory. And we're debiting inventory for the amount we purchased, which is $28,000. Okay. What else did we get? Well, we got a bill. We're going to have to pay it. We're liable to pay it. Liability, it's an accounts payable. We know that because it says, well, it gives you the terms, so we know it there, and it also says we bought it on account. So we are going to credit accounts payable to make that go up, $28,000. So that's an example of a purchase as the buyer. Number 2 says, on April 6th, paid freight cost of $700 on merchandise purchased from Jack's. So when we're the buyer, everything goes to inventory. So where are we going to put the cost of the freight? We're putting it to inventory. So on April 6th, the cost of our inventory went up now because we had to pay for the freight. So we're going to debit inventory, $700. The problem also says pays, and anytime it says pays or paid, we know the cash account is going to be used. We're paying, cash is going down, cash is an asset, has a debit balance, so to make it go down, we're going to credit it. Okay. Now, number 3, on April 7th, purchased equipment on account for $30,000. Oh, well, what do we get? We got equipment. So, April 7th, we're going to debit equipment for $30,000. And it doesn't say pays or paid. So it doesn't say we paid it. So we're assuming if it doesn't say we paid it, we bought it on account. So accounts payable. Now, why are they throwing equipment in the middle of that? Because if you are a seller of merchandise, you don't just buy and sell inventory. You have to buy equipment, you have to pay salaries, you have to pay the rent, all kinds of other transactions come into play as well. So you're not just paying for your inventory. All your transactions are not just about inventory. Okay, number 4. On April 8th, returned $3,600 worth of merchandise to Jack's Company. Okay, so this is April 8th. So what did we get? Well, we got a lower bill and we got lower inventory. And we know that when we're the buyer, purchase returns and allowances go to inventory because everything goes to inventory. And since this is a return or an allowance, that means that the cost of inventory is going down. So inventory is an asset. Assets have a debit balance. So that means we have to credit inventory to make it go down. And then we owe less money. We owe $3,600 less. Accounts payable is a liability. So to make that go down, we have to debit it. So we're going to be debiting accounts payable, $3,600. And we're going to be crediting inventory, $3,600. Then we have number 5. On April 15th, paid the amount due to Jack's Company in full. Okay, so the first thing we have to do is we have to look at the terms and the date. So the terms for this were 2/10. That means we get a 2% discount if we pay within 10 days. So we bought it on April 5th. We're paying it on April 15th. That is within the 10 days. So we get to take the discount. So now we have to do the formula, right? And what is the formula? It is total purchases less any returns or allowances gives us our accounts payable number. The accounts payable number times the discount percentage gives us the discount dollar amount. The accounts payable number minus the discount dollar amount gives us the cash amount. So we're going to figure this one out. Okay, so our total purchases were $28,000, right? $28,000 minus any returns or allowances. And so we had a return of $3,600. So 28,000 minus 3,600 is going to give us an accounts payable number of 24,400. Okay. Now we take the 24,400 accounts payable number times the discount percentage. And in this problem, they said it was 2%. So 24,400 times 2% gives us a discount dollar amount of $488. We then take that accounts payable number of $24,400 minus the discount dollar amount of $488. And that gives us our cash amount of $23,912. That's how much we actually have to pay to the seller. Okay. So we are going to, on April 15th, now we have all our numbers, now we can do our entry. On April 15th, we are going to be debiting accounts payable because we're paying off the bill, so we want our accounts payable to go down. We're going to debit accounts payable. How much? We already did the math and figured it out. The accounts payable is $24,400. Purchases minus any returns or allowances. Okay. We are then going to credit inventory. And we're crediting inventory for the discount dollar amount because we want the cost of our inventory to go down because we got a discount on what we had to pay for it. So we're going to credit inventory $488. And then we've got a pays or paid, right? And we're paying, so our cash is going down. And so we're going to be crediting cash. How much? We already figured it out. The accounts payable number minus the discount dollar amount is $23,912. 23,912. Why is that? There we go. $23,912. So that is, let me see if I can get it all on one screen here so you can see it all together. Let's see.
And I have a question.
With this, 1 second on that. The other part of it says for B is what would happen if we didn't pay the bill within 10 days? So this is actually really easy. It's way easier than you think. If you didn't pay the bill within 10 days, you would not get the discount. So you're going to be paying the accounts payable number. That's all you have to do. So this is part B. So if you paid it on May 10th or May 4th instead, all you would be doing is your accounts payable number that you have, the 24,400, which is the purchase minus any returns or allowances, and the cash number are going to be exactly the same. You have to pay more because you didn't take advantage of the discount. So that's the only difference when you do not, when you pay too late, you can't take a discount.